Good afternoon, everyone. My name is Mark Masson of FD Recruit, and a huge welcome to everyone. And hopefully this will be a very informative, relaxed and enjoyable webinar on corporate finance outlook for 22-23. I'd really like to welcome our expert panelists, Andrew Thomson, Managing Partner of HMT LLP, Nick Wallis, Partner, Gerald Edelman in Deal Advisory, and Rob Smith, Director and Founder of Forward Corporate Finance. So to all those attending, we'd welcome any questions. Please put these in the chat box. Don't email them, as I believe Zoom tells you to, but put them in the chat box, and towards the end of the webinar, we'll answer as many as we can. So let's get started, and I'm going to put some questions to the panel here. First of all, would you like to just introduce yourselves and tell us a little bit about yourself, what's happening in your world right now? Nick, if you want to introduce yourself, that'd be great. Thanks.
Yeah, thanks, Mark. Yeah, it's a pleasure to be on this webinar. So yeah, as Mark says, I'm Nick Wallis. I head up the deal advisory team at Gerald Edelman. We're a mid-market accountancy firm based in London. Our corporate finance, often call it corporate finance, which is split into deal advisory and transaction services. It's a pretty exciting time for us right now. We've grown the team from just 4 or 5 people 3 years ago to 20, and we're constantly growing. And we had a despite kind of the economic challenges and going through COVID in the last few years, we've had a really good few years. And the pipeline is really good, and we're continuing to grow. So it's a really exciting time. In my world personally, we had a team social last night, and alongside a young baby who has forgotten how to sleep. It's been a pretty challenging morning, shall we say? But all good now. All good.
That's great, Nick. Thanks very much, Andrew. Please.
Thanks, Mark. I'm Andrew Thomson, HMT. We're a mid-market corporate finance boutique based in Henley in London. We've been going 30 years now, so we've been through a number of sessions, seen a number of shocks to the economy, and each one slightly different than the last. We're as busy as we've ever been. Typically do 30, 40 transactions a year, 5 to 50 million typical deal size, and fairly sector agnostic.
Great, thanks very much, Andrew. And Rob, please introduce yourself.
Thanks, Mark. So Rob Smith, Forward Corporate Finance. Myself and my business partner, Sarah, set up Forward 5 years ago. We're based out of Stansted Airport, mainly work across East Anglia. Deal sizes tend to be between sort of 2 and 20 million for us. There's 4.5 people in our team. We're looking to grow, same as Nick and Andrew as well. And for my sins, currently I'm not in the UK, hence the background, but I'm about 10 meters away from a swimming pool.
Thanks very much, Rob. Okay, let's shoot into the questions, and I'm going to rotate around the panel on these. So if Nick, if I can ask you this one, and perhaps Andrew, after Nick's spoken, if you want to add anything on this one. So Nick, how have you seen deal structures evolve during last year, and what do you expect in 22-23?
I think in the last few years, rather than specifically last year, obviously during the pandemic, whilst the first 6 months were quiet in terms of deals in 2020, since sort of September, October 2020, the market's just gone quite mad, really. But what we are seeing in terms of deal structures is a lot more contingent consideration, so a lot more earnouts and deferred consideration than we probably did before. I think that's obviously largely given uncertainty of trading, so buyers moving risk to sellers that beforehand they would have probably taken a bit more on themselves. given where we are now, we're sort of coming through the other side of COVID, trading is a little bit more certain than perhaps it was, particularly for some sectors. The last sort of 6 months, we have seen the amount of earnouts and deals reduce, or the quantum of the overall consideration that's in an earnout reduced, especially stuff that's more contingent on hitting certain targets. However, I think with what's going on in Russia, with cost of living, inflation, there is still some uncertainty in the market, and particularly in some sectors that are impacted by those things more than others. We are still seeing that uncertainty is being packaged into deals from buyers. So we're not quite back to where we were sort of pre-COVID, I don't think, in terms of those deal structures, but we are seeing definitely less earnouts than we did, over the last few years in terms of deal structures. But so that's kind of my overall sort of theme on deal structures in the last year or so.
Well, thanks for that very full insight there, Nick. And Andrew, is there anything that you want to add to that?
I mean, what you've got is you've got lots and lots of buyers chasing too few good businesses, but those buyers, and I think it's what Nick said, but those buyers are just incredibly cautious, which is why you've got more going to earn out. That's like turning around, seeing a lot more completion accounts than lockbox accounts, and deals are still taking a long time to complete. People really want to understand how those businesses are performing or going to perform in a post-COVID world.
Thanks, Andrew. And actually, Andrew, next question to you, if I may. Always a good one, I think. What sectors are particularly hot and strong right now, would you say?
Yeah, well, look, I mean, you got a general theme, but I mean, what is attractive? And it's really, the overriding thing are B2B tech-enabled businesses with high levels of recurring and repeat revenues. So those are the obvious ones. So what does that mean? It means IT managed services and cyber security, e-commerce fulfillment. But then we're seeing some other things are pretty active at the moment. B2B marketing, we're seeing quite a lot at the moment. Building products as well, particularly those with a DIY angle. There's a number of PE houses buying and building in fire security, and I guess that's a repeating theme. So I'll say the overriding thing is B2B tech enabled, but there's a few outliers that they're also very active at the moment.
Yeah, no, thanks, Andrew. And Rob, is there anything you would sort of add or
absolutely
reflect on that?
We're seeing exactly the same as Andrew in terms of the tech businesses with recurring income. There's been a lot of deal activity in those sectors. Principally, for us, we're helping own and manage businesses. And so we're seeing a lot of logistics, haulage, warehouse, some good roll-ups in manufacturing as well, in order to get some more bulk onto the business. But I think I tend to agree as well, the construction products sector, we've seen a couple of deals we've worked on over the last 18 months complete in those sectors. So your typical ones, your tech, your construction, and yes, my day-to-day own and managed businesses are still sticking around doing some transactions.
Thanks for that, Rob, very much. I think unsurprisingly, the elements of that on our side and the recruitment side as well that's reflected. I don't know if on that one, Nick, there's would you agree on those sectors or anything others that you would sort of add in there? Or
I completely agree with what Andrew and Rob said. The only other thing is that we're seeing quite a lot in the healthcare market generally, and particularly in health tech. I think healthcare is one of those sectors that was probably positively impacted, depending on what subsector you're in, positively impacted by the pandemic. And there's therefore, there are certain, particularly financial investors, private equity type investors, where, the remit of their sectors is kind of reduced, particularly if they liked sort of hospitality and retail before, and they may know sort of taken a different view. And so things like healthcare, particularly health tech. And the other one is kind of, it links into tech, but more ed tech, so education and technology as well. We're seeing quite a lot of interest in that at the moment. But other than that, completely agree with what Andrew and Rob said.
Okay, no, great. Thanks for that. And Rob, if I could put this one to you, what's your view on how valuations will be impacted in the coming sort of 12 months or so?
Yeah, so valuations for me over the last 20 years of working in corporate finance have always been 4 to 6 times generically EBITDA for all of the businesses that we tend to work on, which will be 500,000 EBITDA business to a 3 million EBITDA business generically. Obviously, the faster growing ones tend to attract higher multiples. But the valuations, of course, links back to what Nick was talking about in terms of the structures, where they've changed slightly over the last 18 months, just due to some uncertainty in the market. And so you're having to see more contingent on the valuation, so coming in from earnouts later on in the transaction. We're definitely expecting valuations to stay around that period. It never seems to change despite the volatility. Clearly, there's some deals that we have worked on and have seen valuations tick up, principally because of the competition that's come to the table, as Andrew said, in terms of the number of businesses, good quality businesses that are being taken to market. And then those buyers looking for those businesses, it can create some competition for the right clients. So we saw one specifically where we had a multiple higher than 6 times, which wasn't what we were expecting, but clearly was a great result for our client.
Yeah. Thanks a lot, Rob, for that. And Nick, is there anything you would add to that?
Yeah, I completely agree with Rob. I think it also depends on the sector. As we said, kind of recurring revenue tech would probably, be a higher valuation than sort of a recruitment business, or a kind of vanilla construction project-based business. COVID did see a dip, I think, in valuations, because while multiples might have been the same, it's actually what EBITDA number are you applying it to? Are you applying it to a pre-COVID number, a current number, and that was kind of a bit of the confusion in that period. Things seem to have bounced back from a general valuation perspective, in our view. Some sectors more than others. I think there's still some nervousness in particular sectors, although, for example, leisure and hospitality, haven't really been trading for a full 12 months as they've been fully open. So that's probably since sort of September last year is when things really started opening more. So again, what valuations are people using? We actually did a cocktail bar business. We sold at the back end of last year. And again, it was a kind of a hybrid of pre-COVID numbers and current trading to kind of get to that, to the valuation that the buyer was happy with and the sellers were happy with. So, but yes, I think that valuations are kind of broadly where they were before. I think they will continue at that level. I think the only caveat to that is particularly B2B tech, where we're seeing more revenue multiples than we probably did before. Particularly, we've sold businesses that have had next to no EBITDA and gone for somewhere between 6 and 10 times revenue at times, which was probably unheard of 5-6 years ago. Apart from sort of exceptional circumstances or much larger companies. So tech is always the anomaly when we talk about valuations, really from our perspective, but that's kind of our view.
Thanks. Sorry, Andrew. Yeah.
I was just saying, I mean, from our point of view, there's been a bit of a polarization of valuations. If it's a good asset and people want it, they will overpay. And I think private equity and trade would rather overpay for a good asset than underpay for a bad one. So we're actually seeing sort of quite scary high multiples and very modest ones, and not a lot in between. I say a complete polarization. I suspect valuations will soften next year. I think there's a lot of supply and demand issue. I think the supply of good business coming to market was fairly limited the last couple of years. I expect that to change, so I wouldn't be surprised if valuations soften next year.
Oh, Andrew, thanks for adding that in. Appreciate it. And Nick, to you, if I can ask, is now a good time to sell?
Well, as a corporate finance advisor, I would say yes, absolutely, everyone should sell. But the honest answer is it really depends on the circumstances of the business and the business owner or owners. I think the two key things is that the business needs to be ready for a sale exercise, and the owners need to be ready for a sale exercise. And we often see people say, I want to sell my business, but in reality, they're not ready to sell from a personal point of view. Whether or not they stay in the business post-deal, it's a very different mindset, staying but working for someone else, or not being involved in the business, particularly if you're an owner-manager that started up a business yourself and it's your baby. So we always say to people, just make sure the timing is right from your perspective, that the business is ready. There's no skeletons in the closet. The business is on the right growth trajectory. and the owners are ready from a personal point of view. And if those things are in place, then yes, it's a good time to sell. I think in terms of the market dynamics, there's a lot of cash out there, so that helps. When we were talking about, valuations are fairly strong right now, so yes, makes it a good time to sell. Tax rates are currently still very attractive. I know Entrepreneurs Relief obviously was reduced a couple of years ago, but tax rates for selling are still more attractive than income or dividend rates. So that we don't have any visibility of that, and there are rumours that that's going to change over the last few years. It hasn't. It may do. So from those perspectives, yes, it is a good time to sell. But fundamentally, I think it depends on the circumstances of the business and the sector really as well.
Thanks very much, Nick. Andrew, is there anything you'd like to add to that?
I just agree with all that. I think you look at the macroeconomic factors, it is a good time to sell. Lots of corporates are acquisitive as we enter a low growth, high inflation period. Loads of firepower in private in the debt market. So loads of liquidity out there. Capital gains is not going to get better. So it is a good time to sell at a macro level. But as Nick said, it's all about your individual circumstances, whether it's the right time to take your business to market. Yeah.
No. Thanks, Andrew. And I'm going to put this one to you, if I may, Andrew. What's your advice to owner managers who might be thinking of selling in 2022? Any specific advice you'd give?
Well, the first thing is to pick up the phone to me and appoint HMT. But beyond that, I mean, if you want to sell this year, you really need to start the process now. I think before you do that, you've got to be really realistic. Is the business ready? Where are you on valuation? Have you actually got the bandwidth to go through a process? I mean, sales processes we mentioned earlier are being longer, are becoming protracted. You need to make sure you're actually ready to do that. I guess the questions you've got to demonstrate you're resilient when there is an economic shock, as you were in COVID. But the key thing when we're selling businesses is about being able to demonstrate that you've got clean COVID numbers. So how much of the current profitability is because of a bounce back from COVID? So it's demonstrated the sustainability of that, and that's the key. I mean, that's how you're going to get the valuation from a 5 and a 6 to an 8. It is demonstrating that.
Thanks, Andrew. I'm going to take all that advice as well, given Nick's comments about the recruitment sector. But you're still invited on the next webinar, Nick. Don't worry about it. Rob, is there anything you would add to Andrew's comments on that?
I completely agree with Andrew. You should absolutely talk to Andrew, Nick, or I if you're thinking of selling your business, because clearly we can give you an insight into what we think as an early shout, and whether the business is ready, the owners are ready, as Nick said. Whether you're in the right place from a COVID bounce back position, and whether it's the right time for you. So there's no hard sell from any of us when we're doing our first initial pass, but you do find that there's plenty of good value that comes out of that, so that you can see whether now is genuinely the right time for you because you and your business are ready, or whether there needs to be a period of time for some of the skeletons to come out or to be erased. Or perhaps for the business to return to a normal trading period, or what can ever be considered as normal in today's market.
Thanks a lot,
Rob. Mark, I just add one comment to that.
Sure.
I think that whether it's 2022, 23, 24, or at some point, if you are considering a sale, it's never too early to start that process, as Rob says, around checking the skeletons, because at some point you may be approached by someone out of the blue. And if you're thinking of selling, you're going to have to go through that process at some point. I think the other key thing we see is the reliance on business owners. And I think business owners come, right, and now I'm going to sell my business, but actually the business is still very reliant on them. So we'd always say encourage as early as possible to think about that succession plan, so the business is less reliant on you, regardless of whether you want to stay involved post-deal, because it depends on the buyer, who the buyer is, etc., whether they would want you to stay involved. But I think, from a valuation and saleability perspective, the less reliant the business is on the business owner, the better. So start planning for that now.
Thanks a lot, Nick, for adding that. Very, very welcome. And Rob, a question, if I may put to you, is now a good time to make acquisitions?
Yeah, absolutely. I mean, we over the last 18 months have done quite a bit of work with a couple of mid-market private equity firms who have done lots of bolt-on acquisitions to portfolio companies that they'd already invested in, principally because they knew those portfolio companies, they trusted the management, and they're still, I'm led to believe, sat on quite a lot of what's called dry powder, so cash to invest. So they're very acquisitive. Big corporates, likewise, we have one specifically big corporate client that's done 2 acquisitions throughout this period and is looking at another 2 now, principally for growing their businesses without having to focus specifically on organic growth, which is very tough at the minute. And trying to grow in this climate, whilst everyone else is trying to maintain, is actually very challenging. So if you do need to grow a bit quicker because of some strategy that you have in your specific corporate or private equity backed business, acquisitions are the way to go. But be prepared, obviously, if you're going to be buying business that looks solid, that there will be competition out there.
Thanks very much, Rob, for that. And Nick, I don't know if there's anything you might want to add to that.
Yeah, I think the only thing I'd add is, the question: is it a good time to make acquisitions? Well, yes, because from a seller's point of view, there are a lot of business owners where their mentalities may have changed because of the pandemic in the last few years. So people are probably, so it's not everyone, of course, but some people that may have not been thinking about selling have now changed their views. So if they get an approach and there's an opportunity to de-risk, they may take you up on it, whereas they may have not done before. They may also have been through a very tough time. So maybe, it depends on the sector and the business, able to accept a slightly lower valuation. So that makes it obviously a good time to buy. Plus, financing is cheap and available. There's a lot of cash out there, as I said before. So I think all those things kind of add to Rob's point to make it a good time to make acquisitions for sure.
Thanks a lot, Nick. And I'm going to put this one to you. Nick, what are private equity looking for in a platform deal, in a bolt-on deal, would you say?
Yeah, I mean, Rob touched on it before, and kind of going back to, is it a good time to make acquisitions? The whole reason for a sort of a buy and build strategy, or one of the main reasons, is kind of the concept of fast growth and multiple arbitrage. I.e., the bigger a business, the higher the multiple. So by combining businesses together, you tend to get higher valuations, even if there are no synergies. But in reality, private equity are looking for synergy, so a platform investment that is normally a stable but growing and cash generative business, and then bolt-ons that can add to a specialist capability, or so that with synergies, or kind of grow and add a new infrastructure or sales facility or something else. To from a sales synergy perspective, but also from a cost synergy perspective, and all of those things. So if you can increase EBITDA because you've got synergies, and reduce costs, and you've got the multiple arbitrage point, it's kind of win-win from there. So you might buy 3 businesses at 6 times EBITDA each, but the chances are when you sell them together as a group, you're going to sell them for more than 6 times. But in reality, you're going to sell them for more than 6 times a bigger number. So that's kind of the concept of the buy and build strategy. And that's kind of why the private equity buy and build model has not always, but tends to be quite successful.
Thanks a lot, Nick, for that. And Andrew and Rob, is there anything you would add to that?
Yeah, I suppose I would say it's very much sector driven as well. If you look how private equity source buy and build opportunities, they will identify sector, go and map it. So it's got to be a sector that's right for consolidation or is consolidating. Their ideal model is to be a sub-consolidator, so put a few of these together and sell them to one of the big boys. So the market sentiment is really important, and the other key thing is to have a management team with bandwidth that can run a much larger organisation and will grow with the business.
Thanks, Andrew, for that. And Andrew, if I can actually put to you this question: what debt options are there for SMEs doing MBOs or acquisitions?
Yeah, we've done a lot of debt-only MBOs recently, which we wouldn't have done before. I mean, if you go back a few years, you had the debt funds that were really only accessible to companies with EBITDA sort of 5 to 10 million and above. All these debt funds are now gone into the SME market. So there's just lots of them out there. So it's not the high street banks. It's it's all these debt funds that will put 3 or 4 times EBITDA leverage in, and with that and some deferred consideration from the vendor, you basically got a debt funded MBO, and we are seeing more and more of those.
Thanks a lot, Andrew, for that. Rob, was there anything you would add to that?
Yeah, exactly the point Andrew's made. We're seeing the debt options available for businesses that are 500,000 EBITDA up to 2-3 million. They're really expanding outside of high street banks into your challenger banks and into your debt funds who are coming down into the SME market to play. So we funded an acquisition that was 8 million of debt last year, and we had lots of competition, and the debt ranged from 5-year terms with a bullet attached to it, all the way through to a 6-year term with 100% capital repayment at the end, but some quite racy interest rates attached to those. So it gave our client the ability to choose what sort of debt they wanted to make that acquisition. And as Andrew said, the same is true of the MPOs that we're working on. Some of those where you'd have thought you might need a bit of an extra equity slice or perhaps even more deferred to the vendor can now be done a hell of a lot more straightforward with a decent slug of perhaps 3 times EBITDA as debt, which is good and affordable and available.
Yeah, so if you can buy that asset-based lending as well, it can be quite a cost-effective option.
Thanks very much, and thanks, Rob, for that. To all the participants out there, by the way, do put any questions in the chat box, and we'll try and get around a few of those in the last 10 minutes or so. So we'll come on to the last few questions, and then I'll put some of your questions to the panel. Rob, if I can ask you one in relating to the banks, really, do you think the banks will continue to fund transactions as they have been in 2022, 2023?
Well, in our experience, the high street have obviously put out a lot of money through the pandemic, and so it's actually becoming quite challenging for them specifically to fund some of the transactions that we're working on, unless they are currently with that bank. Outside of that, the banks, in terms of challenger banks, there's a lot of options there for us now when we need to go to them for an acquisition or for an MBO. And so we're finding it actually quite good fun, is that the right word, to be able to place a transaction like that, because there are a number of people that can be quite competitive in that market. So I think it depends on the bank that you're talking about in terms of who will be funding those transactions, but the options are definitely there, and I think they will continue to be so.
Thanks for those comments, Rob. And Nick, is there anything you might want to add to that?
Completely agree with Rob from what we're seeing. Traditional banks probably less so, but alternative lending or the kind of the second tier of banks, then yes. Also new forms of funding that we're seeing. So things like, I don't know, merchant cash advance, which is where you borrow money based on credit card sales in a consumer business. That sort of product wasn't around 5 years ago, and that sort of thing. We're seeing more and more of that as alternative funders, and people, there's a lot of capital out there in that regard as well. So yes, I think that the sourcing of funding in the next year, 18 months is not going to be an issue from an acquisition point of view.
Thanks, Nick. And if I can ask you this question, do you think there will be more distressed M&A this year and next year?
It's interesting because when the pandemic started, I think we all probably thought, okay, the M&A market's going to slide away, but actually there's going to be quite a lot of distressed M&A happening because there'll be a lot of distressed businesses. And in reality, that hasn't, yes, there's been some distressed businesses depending on sector, but it hasn't really happened. We haven't seen, from our perspective anyway, a massive uptick in distressed M&A. To be fair, it's not really something we get too involved in. But I do think that as with the cost of living crisis in inverted commas, with the end of COVID measures, for example, in leisure and hospitality, the last measures were ended a few weeks ago with VAT, etc. With a rent moratorium coming to an end, those sorts of things will have an impact on some businesses. which means that some businesses will be more distressed, and therefore by nature there probably will be more distressed M&A. Obviously there are some specific sort of turnaround distressed funders out there who obviously having probably benefited from the pandemic, especially if businesses have that opportunity to restructure and therefore turn around the business, because by its core it's a good business. It's just had kind of a difficult balance sheet or whatever else because of the pandemic or otherwise. But I think in answer to your question, Mark, I think there would be more distressed M&A, but I don't think it's going to be anywhere near the levels that we thought it probably would have been 2 years ago.
Thanks for that, Nick. Andrew, is there anything you'd want to add to that?
I think Nick covered it all. I guess I would say, what do I say? So I think more stress than de-stress. I think the de-stress stuff in some of these sectors, they just implode, and there's actually nothing there to transact. But probably more stress rather than de-stress going forward for the reasons Nick just covered.
Thanks very much, Andrew. And we're coming. This is now the sort of final panel question, as it were, before I asked a couple of questions from the participants on the chat. And I'll put this one to you, Andrew, and Nick and Rob, if you want to comment after, please do. So finally, what is private equity's appetite to invest likely to be during this year and next year, do you think, Andrew?
I mean, it's difficult to sort of stretch this answer out to more than a few words, but stronger than ever. They've just got so much dry powder. Their business model is to deploy capital. They've got lots to deploy. And I think probably, there's a lot going on in the world. We're not sure how next year is going to turn out, but one thing that private equity did learn from the last recession is that those that did the best were those that invested throughout the economic cycle. And I think they've all learned that lesson. So I think whatever the economy looks like next year, PE will be investing, and they've got capital to deploy.
Great. And Rob, anything you might want to add to that, or
just as succinct as Andrew? I think where we're finding a little bit of assistance from private equity as well is in our sale mandates. If we can find a private equity investor that has invested in a good platform business and is acquisitive for the businesses we have for sale, we're finding them actually competing and completing quicker than trade, principally because of the dry powder, as Andrew said, sat there. It's not earning them any money in the bank, it needs to be invested, and it gives us a lot of confidence when we see a PE on the other side of a sale mandate in comparison to perhaps a trade buyer that's got their own business to worry about at the same time.
Pick up a theme that Nick mentioned earlier. We talked about making sure that management were not over-reliant on the business. Actually, private equity are quite comfortable doing cash-out deals, partly cash-out, and actually working with the management team to effectively make them redundant over sort of 3-4 year hold period. So actually they are, and we wouldn't have seen that a few years ago, they are more likely to accept that than perhaps trade, where there is a reliance on management team.
Well, thanks very much, everyone, on that. Nick, I don't know if there's anything you want to add on there.
I was just going to make Andrew's last point, actually, and I think it's actually one of the questions that might have come up. But yes, so we are seeing where private equity maybe before would have had to take a majority stake, actually might be more inclined to take a minority stake, actually give the owners some money to de-risk, not retirement money, not go and sit on the beach money, but actually money to de-risk, pay off their mortgage, school fees, all that sort of stuff, so that they're more financially secure in their personal life. And actually then it changed their risk appetite. So actually once they've got their financial security, they're more likely to kind of not necessarily take big risks in the business, but maybe change their decision making slightly, where it's someone else's money. If all goes wrong, they've already de-risked and they're financially secure, albeit they can't necessarily retire. I think those sorts of deals we are seeing more of, and actually we're actually seeing vendors want those sorts of deals. They want to stay in the business, but they also want to take some money out to de-risk, sort of the best of both worlds. And as Andrew says, I think 5 years ago that would have been quite rare, whereas now we are seeing that style of deal more. And actually it works both ways. It works for private equity and it works for the vendors, which is great.
Thanks very much. So thank you for all of that. And I certainly learned a lot, bringing myself up to date on the corporate finance scene. I'll go to a couple of questions which we've just got time for before I close off on this from some of the participants. And Dr. Turner has asked, are we seeing tech valuations based off of revenue where in startup mode and non-profitable? I'll read that again. Are we seeing tech valuations based off of revenue where in startup mode and non-profitable?
I mean, it all depends on. The major factor driving that is the growth rates. If you're growing at sort of 4 or 5 times per annum, then yes, it's all about that growth rate. So they can use a DCF, discounted cash flow valuation. So it's all about the extent of that growth. And you see, very early stage business with minimal revenue growing very quickly, you will see ridiculous valuations. So yes, subject to understanding what the growth rate is of those businesses.
I agree with that, and I think in reality, so a lot of these businesses, it's not really a multiple of. You might backwards work it to be a multiple of revenue or a ridiculous multiple of a very low EBITDA or something like that. But in reality, it's based on the future projections, whether it's DCF or another way of looking at it, and working out what's the business likely to do in the future, and therefore what's the valuation likely to be, and therefore what's the upside opportunity. If that makes sense. We've sold businesses in the last couple of years that have gone for ridiculous valuations, but in reality, then they're not, because the buyer knows that they can effectively plug the existing tech platform or business into their infrastructure, and the business could be 4 or 5 times bigger overnight because of the infrastructure, and therefore they're paying a premium, higher multiple of revenue or whatever it is. But in reality, it's calculated. They're underpaying because they know what they can do with it. So, like with anything, the valuation is what someone's willing to pay for it, and someone's willing to sell it for. But the answer, I think, the simple answer to the question is yes, we are seeing multiples of revenue. But I'd always think about it in a maybe slightly different way as well.
And Rob, any comment you want to make on that at this point?
I mean, Nick's nailed it really. The future cash flows are always what's important to every acquirer, whether it's them that can generate those future cash flows through bolting in that business that they're acquiring, or whether it's the cash flows of the business they're acquiring. So whilst the valuation might look a bit strange based on EBITDA or turnover of a tech business as it's being sold, it's more to do with the returns to the investor.
Thanks, Rob, for that. And so I'll ask one sort of final question from one of the participants. Samuel has asked, and this is to do with, are the panel seeing any minority deals? And before asking that, Sam has said selling doesn't always mean selling control, i.e. over 50% via a majority stake. There are PE houses out there like Roycian that would consider buying a minority stake if you want to liquidify some of your share certificate and carry on going for a few years while working out a full exit event down the road. And as I say, he then asks the question, are the panel seeing any minority deals?
Yes, I guess a couple of caveats there. What often drives that are actually the tax structuring of the vendor to make sure they get capital gains treatment. And in some circumstances, they would have to sell majority control. I think the other thing is, whilst they are minority deals, there will be the private equity houses will take strong protections. They will have the ability to step in and control the board or swamp the equity if things start going wrong. So you could sell a minority stake, but you could be losing control through another means. So I wouldn't get completely hung up on the percentage number that's being sold. It's much more complicated than that. So it is about understanding what rights you're giving away under the investors agreement.
Yeah, I agree with that. And also what we're also seeing is a lot of these deals, we are seeing minority deals, and a lot of the time they're funded with loan notes or pref shares. So in reality, I mean, not necessarily for kind of management will take, say they took 40% out and keep the numbers really simple, and they retained a 60% equity stake. It's not necessarily 60% of the overall equity, because the investor will have funded it with loan notes. They're actually only getting 60% of the valuation above today and the future. So there's that downside for the private equity firm is protected. But sometimes management are kind of happy with that on the basis they've de-risked today, and they know that the business is going to grow, and they've now got someone to support that growth, and therefore that their 60% in my example is still worth a hell of a lot more in the future. So.
Sorry, Rob, any comment on that?
Other than to both Andrew and Nick's points,
yeah,
it's about structuring the deal in the right way for both sides, and then absolutely the de-risking bit that Nick mentioned probably a couple of minutes ago, with vendors seeking to take some off the table and pay off the mortgage and put some money in the pot for the kids for later when they're going through university, and change their view slightly on risk appetite going forward, in the knowledge that they've got an investor behind them that wants them to grow that business, rather than it just being them sat in the lonely board seat at the top of the tree on their own. But no, completely agree with Andrew and Nick on
the one additional thing I'd add is that we've seen, particularly in the last couple of years, it's kind of more, so not necessarily private equity, and actually not that many of them in the UK, but actually quite a few in Sweden in particular, sort of the longer term investor. And we've done a couple of deals in the last few years whereby someone will come on board as a long-term investor, not with a 3 to 5 year exit horizon. And the idea is that they'll kind of build up their portfolio and probably list an overall group in sort of 10 to 15 years time. And that's their ethos. And I hadn't come across them personally 3 or 4 years ago. And we're seeing a few more of them come up now. And I say we've just done a deal with a few of them. In terms of what Andrew was just saying about stringent protections, yes, of course, they've got their protections, either minority or majority protections. But the overall deal's a lot simpler, a lot smoother. They're kind of less strict and stringent than private equity in the UK. And generally, they're focused on that long-term growth rather than that short-term fix. And it's not for everybody, but for some of our clients in particular, particularly those in a sort of a family business, the idea of the reputation of private equity. This has been a more attractive option for them, and we're seeing more of that. I think that's probably going to grow. I can't see too much of it in the UK, although we're seeing a few. But I say a couple of the people we've done 2 or 3 deals in the last year with Swedish houses, and I think there's a few others out there as well, maybe across Europe.
Yeah. Well, thanks very much for that. That's been fantastic, and so as we bring things to a close, I'd very much like to thank Andrew, Rob, and Nick for making this such a good session. I'd also like to thank all the participants for attending and those great questions, and I hope you all got something out of it. And feel free to make contact with the panelists about your businesses, fundraising, corporate finance, private equity related issues. I know they would be delighted to hear from you. And please do let us know any feedback on today, your thoughts. Myself or a colleague will email you all a link to a post that I'll be putting on LinkedIn where you can comment if you wish. And hopefully you'll interact on something one way or another with FD Recruit in due course. We have ongoing webinars, boardrooms, etc., and perhaps see you on another one. So again, thank you very much. Have a great day, and catch up shortly. All right. Thanks,
Mark.
Thanks, Mark. Cheers.
Everyone.
Bye, everyone.
Bye-bye.